Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Credit Acceptance Corporation Annual Report. Credit Acceptance Corporation offers a range of financing programs and related services to automobile dealers in the United States. At its core, the company provides financing to dealers by advancing money in exchange for the right to service underlying consumer loans. This allows consumers to purchase vehicles from participating dealerships. In addition to financing, Credit Acceptance also buys consumer loans directly from dealers, retaining a portion of the payments collected from borrowers. The company further diversifies its offerings through vehicle service contracts, which provide protection and warranty coverage to consumers purchasing vehicles financed by the company. These contracts are reinsured by the company, providing an additional layer of security for both dealers and consumers. The company's services cater specifically to independent and franchised automobile dealers, making it a key partner in the automotive retail industry. With its extensive experience dating back to 1972, Credit Acceptance Corporation has established itself as a trusted provider of financing solutions and related products to the automotive sector. The stock price of Credit Acceptance Corp. (CACC) experienced a decline of around -7.76% in the past year. Several news events contributed to this downward pressure on its stock price. One such event was the Q4 2025 earnings report, where despite exceeding EPS expectations, the company missed revenue forecasts and reported a decline in active dealers and market share. Additionally, insider selling activity also weighed on the stock price. In early February 2026, several Credit Acceptance insiders sold a significant amount of their company's stock, including CFO Jay Martin and Director Kenneth Booth. This insider selling can sometimes signal a lack of confidence in the company's future prospects. While these events likely exerted downward pressure on CACC's stock price, it is worth noting that no single news event directly correlates to the -7.76% drop. However, they collectively contributed to the decline, making them significant factors to consider when analyzing the company's performance. Credit Acceptance Corporation market capitalization of $5 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Credit Acceptance Corporation holds a significant advantage in their industry. Credit Acceptance Corporation trades at a higher price-to-earnings ratio of 13 times and a higher price-to-book ratio of 3.39 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 80% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted. On the growth side, an increase in consumer loan assignment volume, dealer enrollments, and active dealers have contributed to higher revenues. Additionally, a decrease in provision for credit losses, coupled with an increase in finance charges, average balance of loan portfolio, and interest income earned on loans, has also driven revenue growth. On the decline side, a year-over-year drop in consumer loan unit and dollar volumes has led to decreased revenues. Furthermore, an increase in interest expense and provision for credit losses, as well as delinquencies, defaults, repossessions, and losses on consumer loans, have all contributed to revenue decline. External factors such as changes in consumer demand, inflation, higher gasoline prices, and regulatory changes have also impacted consumer confidence and disposable income, ultimately affecting revenue growth. The net income of the company underwent significant changes between 2024 and 2025. On one hand, it increased by $176 million, or 71% from 2024 to 2025, indicating a substantial growth in earnings. However, this increase is not consistent across all scenarios. If forecasted future net cash flows on loans decline by 1% as of December 31, 2025, the net income would decrease by $56.4 million. Furthermore, there was also a decrease of $175,999,000 from 2024 to 2025. The profit margins of the company showed an improvement over the years, increasing by 10% from 2016-2025. This increase can be attributed to several factors. Firstly, the finance charges increased by $149.1 million, or 7.5%, contributing positively to the profit margins. Secondly, there was a decrease in provision for credit losses on forecast changes of -$155.5 million, or -31.5%. Lastly, total costs and expenses decreased by -$81.1 million, or -4.4%. However, despite these improvements, the profit margins declined due to decreased forecasted collections on purchased loans. The company's ability to generate positive operating cash flow has been a mixed bag over the years. According to various pages of the report, there are instances where the company generates positive operating cash flow and others where it does not. For instance, on page 33, it is stated that the company experienced positive operating cash flow from 2016 to 2024, but turned negative in 2025. However, other sections of the report provide a more optimistic outlook. On page 50, the operating cash flow for 2025 is reported as $2,141.8 million, indicating a significant amount of cash generated from operations. Similarly, on pages 58 and 75, it is mentioned that the company has been generating positive net cash provided by operating activities in recent years, with amounts ranging from $1,054.6 million to $1,203.8 million. The report also provides an explanation for the company's ability to generate positive operating cash flow. On page 39, it is stated that the decrease in provision for credit losses has exceeded the increase in operating expenses, contributing to the company's positive operating cash flow. Overall, while there are some instances where the company experiences negative operating cash flow, the majority of the report suggests that the company is generating sufficient cash from operations to support its activities. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt levels, the company has experienced a substantial increase, with its debt rising from $7.5 billion in 2024 to $15.5 billion in 2025, page 30. This represents a 5.7% increase from the previous year. The funded debt-to-equity ratio also increased to 4.2 to 1 as of December 31, 2025, page 35. The interest expenses have also seen a significant jump, increasing by $43.4 million from $419.5 million in 2024 to $462.9 million in 2025, page 40. This represents an increase of 10.3% over the previous year. It is worth noting that while there are some inconsistencies in the information provided across different pages, it appears that both debt levels and interest expenses have increased significantly over the past year. Management is expressing concerns about the company's outlook and strategy, citing several key issues. Firstly, they acknowledge that their business model relies heavily on access to capital, which could be a significant risk if funding sources are not available. Additionally, management notes that the company's growth may require significant investment in new technologies, highlighting the need for continued innovation. The company's consumer loan portfolio has underperformed expectations, with declining collection rates and slowed net cash flow timing. Management is adjusting their forecasting methodology to reflect actual performance trends, but this has resulted in a decrease in estimated future net cash flows. Furthermore, management recognizes that the company's business model makes it more vulnerable to economic downturns due to its focus on consumers who don't qualify for conventional financing. To mitigate these risks, management is investing in business growth and product enhancement speed for dealers and consumers. They are also recognizing contingent losses related to legal matters and adjusting their forecasting methodology to reflect actual performance trends. However, the company's reliance on outsourced business functions increases operational complexity and decreases control, making it vulnerable to negative publicity. Management is focused on maximizing economic profit over the long term, using a statistical model to estimate expected collection rates for consumer loans. They are also managing interest rate risk through the use of derivatives such as interest rate caps. However, they do not have a specific plan to reduce their exposure to floating rate debt, but may consider hedging strategies in the future. Overall, management's outlook and strategy are centered around adapting to changing market conditions, investing in innovation, and mitigating risks associated with economic downturns and declining collection rates. The company's financial activities have been focused on share buybacks in recent periods. According to the provided summary, a significant number of shares have been repurchased by the company. On page 29, it is stated that 424,805 shares were purchased, while page 99 reveals an even larger total of 1,513,838 shares repurchased. Unfortunately, there is no clear information available regarding dividend payments made by the company. There are concerns about inventory buildup and supply chain disruption that could impact our business. One concern is inventory buildup, which has been observed during economic recessions when there is a significant increase in used automobile inventory. This can negatively affect demand for our financing programs and weaken collateral values. Another concern is supply chain disruption, which can occur due to untimely or discontinued services from vendors. Additionally, public health emergencies, such as contagious disease outbreaks, could cause disruptions in the workforce, further exacerbating supply chain issues. These potential disruptions highlight the need for careful planning and contingency measures to mitigate their impact on our business operations. That concludes the financial summary for Credit Acceptance Corporation. Feel free to comment below, and I will be happy to answer them when possible.